Many people gave up the values they held dearest, and it cost them millions. The worst financial decisions during a recession don't start with numbers. They start with emotions. Fear creeps in slowly at first. A headline here, a market drop there, layoffs trending on social media, and suddenly everything feels unstable. Rational thinking begins to fade, replaced by urgency. And that urgency is where the damage begins. Markets have always moved in cycles. Booms followed by downturns. Growth followed by contraction. Yet every single time the economy dips, there's a wave of people convinced that this time is different, that recovery won't happen, that everything is about to collapse permanently. That belief alone has wiped out more wealth than almost any recession itself. People don't lose money just because markets fall. People lose money because of what they do when markets fall. Mistake number 1: panic selling. This is the mistake that quietly destroys decades of effort in a matter of weeks. It starts with watching investments drop day after day, 1%, then 2%, then 5%. At first, it feels manageable, temporary. But as the red numbers stack up, something changes internally. Doubt begins to replace confidence. Long-term investors, people who once believed deeply in staying invested, suddenly begin questioning everything. The strategy that felt solid during good times starts to feel fragile. The logic begins to break down under pressure, and then comes the moment where fear takes over completely. Assets are sold, positions are closed, entire portfolios are liquidated, not because of a strategy, but because of discomfort. During the 2008 financial crisis, even disciplined investors who had followed long-term strategies for decades abandoned their plans. Many sold near the bottom, locking in losses that would take years, sometimes decades, to recover from. Some never returned to the market at all. The same pattern repeated in 2020. As markets dropped rapidly, panic selling surged, retirement accounts were drained, investment portfolios were cut down drastically. But what happened next tells the real story. The recovery came fast, faster than most expected. Those who stayed invested saw their portfolios rebound. Those who sold missed it entirely. Missing just the 10 best days in the market over a decade can cut overall returns dramatically. And those best days often come right after the worst ones. That's the trap. Selling during panic doesn't just lock in losses, it removes the chance to recover. This isn't just about numbers, it's about behavior. Fearful investors tend to buy when things feel safe and sell when things feel dangerous. Unfortunately, that usually means buying high and selling low. The market doesn't punish people for being wrong occasionally. It punishes people for reacting emotionally at the worst possible time. Staying invested during volatility isn't easy. It goes against instinct, but history shows that patience consistently outperforms panic. Mistake number 2: not having an emergency fund. Recessions don't just affect markets, they affect income. Jobs become uncertain, businesses slow down, opportunities shrink, and without a financial buffer, even small disruptions can turn into major problems. An emergency fund isn't exciting. It doesn't generate returns like stocks. It doesn't feel like progress in the same way investing does. But during a downturn, it becomes the difference between stability and chaos. Without savings, people are forced into difficult decisions. Investments get sold at the worst time just to cover basic expenses. Debt begins to pile up. Stress increases, which leads to even worse financial decisions. During past recessions, households with no savings were hit the hardest. Not necessarily because they earned less, but because they had no margin for error. One unexpected expense or one lost paycheck was enough to create a downward spiral. On the other hand, those with even a modest emergency fund had options. They could wait. They could make decisions calmly instead of reactively. They could avoid selling assets at a loss. Financial stability isn't just about how much is earned. It's about how much flexibility exists when things go wrong. A strong emergency fund creates that flexibility. It acts as a buffer between uncertainty and decision-making. It allows time to think, to plan, and to act strategically instead of emotionally. Most financial setbacks during recessions don't happen because of one big mistake. They happen because of a series of small, reactive decisions made under pressure. An emergency fund reduces that pressure significantly. Mistake number 3: falling for get-rich-quick schemes. When money feels uncertain, the desire to fix everything quickly becomes stronger. That's when risky opportunities start to look appealing. Promises of fast returns, guaranteed profits, easy money with little effort. During recessions, these schemes become more common and more convincing. They evolve. They look legitimate. They often come disguised as real business opportunities or investment strategies. The psychology behind this is simple. When traditional income feels unstable, the idea of creating a new income stream quickly becomes attractive. And when something promises fast results, it taps directly into that urgency. But the reality is far less appealing. Most get-rich-quick schemes rely on recruiting others, selling overpriced products, or exploiting short-term hype. They rarely create sustainable income. Instead, they drain time, money, and energy. What makes them dangerous isn't just the financial loss. It's the distraction. Time spent chasing unrealistic opportunities is time not spent building real, stable income sources. During difficult economic times, legitimate ways to earn money still exist. Freelancing, remote work, skill-based services. They may not promise instant wealth, but they offer something more valuable: consistency. The hardest truth to accept during a recession is that there are no shortcuts. Building income takes effort. Building stability takes time. And anything that claims otherwise should be approached with extreme caution. Mistake number 4. Going all in on speculative investments. Recessions create volatility, and volatility creates opportunity. But not all opportunities are equal. Some people see market downturns as a chance to invest wisely. Others see it as a chance to gamble. There's a difference between calculated investing and reckless speculation. And during uncertain times, that line often gets blurred. Putting all available money into one asset, one trend, or one idea is one of the fastest ways to lose financial stability, especially when that decision is driven by hype rather than understanding. Speculative assets like penny stocks, meme stocks, or trending cryptocurrencies often attract attention during downturns. Stories of massive returns circulate quickly. Social media amplifies success stories while ignoring failures. What doesn't get highlighted is how many people lose money chasing those trends. Investing should be based on strategy, diversification, and long-term thinking, not on trying to time the market perfectly or chasing the next big thing. Even experienced investors struggle to predict short-term movements. For someone without experience, going all in becomes extremely risky. The goal during a recession isn't to get rich overnight. It's to stay financially stable and position for future growth. Mistake number 5. Using debt to invest. This mistake often starts with good intentions. The idea of using borrowed money to accelerate returns can seem logical, especially when markets appear to be at a low point. But leverage works both ways. When investments go up, returns are amplified. But when they go down, losses are amplified just as quickly. And unlike investments, debt doesn't disappear when things go wrong. During the housing crisis, many people used leverage to buy multiple properties. On paper, it looked like rapid wealth growth. But when the market turned, those same individuals faced massive losses. Debt adds pressure. It removes flexibility. And during a recession, flexibility is one of the most valuable financial assets. Using borrowed money to invest increases risk at a time when stability should be the priority. Mistake number 6. Not cutting expenses early enough. One of the quietest but most damaging mistakes during a recession is continuing to spend like nothing has changed. Income might still be steady, bills are getting paid, life feels normal on the surface, and because of that, there's a tendency to delay any kind of adjustment. That delay is where the problem begins. Recessions don't usually hit everyone at the same time. Some people feel the impact immediately through layoffs or reduced hours. Others experience it months later. But by the time the effects become obvious, the window to prepare has already started closing. Spending habits that felt manageable during stable times can quickly become unsustainable when income shifts. Subscriptions, dining out, impulse purchases, and lifestyle upgrades slowly drain resources that could have been used as protection. What makes this mistake particularly dangerous is how avoidable it is. Simply being aware of where money is going creates the ability to adjust. It doesn't require extreme sacrifice or cutting everything out completely. It requires intention. When expenses are reduced early, even slightly, it creates breathing room. That breathing room can be the difference between staying in control and being forced into reactive decisions later. The goal isn't to eliminate enjoyment. The goal is to prioritize stability while uncertainty is high. Mistake number 7. Not having a clear plan. When uncertainty increases, the need for direction becomes more important than ever. Yet this is exactly when many people operate without a plan. Without a clear plan, decisions become reactive. One idea leads to another. One strategy gets replaced by the next. Effort gets scattered, and progress becomes difficult to measure. A recession amplifies this problem. Stress levels rise. Information overload increases. Every headline feels urgent. Every opinion sounds convincing. And without a plan to filter through it all, it becomes easy to jump from one approach to another without making real progress. A solid financial plan doesn't need to be complicated. It needs to answer simple but critical questions. How will expenses be managed if income changes? What actions will be taken if a job is lost? What investments will be continued, adjusted, or paused? What new income streams can realistically be built? Having these answers ahead of time removes the need to make decisions under pressure. It replaces panic with clarity. Plans don't eliminate uncertainty, but they reduce the impact of it. Mistake number 8. Ignoring the psychological trap. At the core of every financial mistake during a recession is psychology. Numbers don't cause panic. Emotions do. Seeing a portfolio drop triggers fear. Hearing about layoffs triggers anxiety. Watching others react amplifies both. And once those emotions take control, logic starts to fade. This is why so many people repeat the same mistakes across different economic cycles. The external events change, but the internal reactions remain the same. During every downturn, there are voices saying the system is broken, that recovery won't happen, that everything is different this time. And those messages are convincing because they align with what people are already feeling. But history shows a different pattern. Markets recover, economies stabilize, opportunities return. The challenge isn't predicting when that will happen. The challenge is maintaining discipline while waiting for it to happen. Emotional decision-making often feels right in the moment. It feels like taking control. But in reality, it usually leads to outcomes that are far worse than staying patient. Recognizing this pattern is one of the most valuable financial skills. It creates awareness, and awareness creates space between emotion and action. Mistake number 9. Failing to build a war chest. Preparation isn't just about avoiding risk, it's about creating opportunity. A strong financial position during a recession doesn't just protect against losses, it creates the ability to act when others can't. This is where the concept of a war chest becomes powerful. A war chest is more than just an emergency fund. It's a combination of savings, liquidity, and flexibility that allows for both defense and offense. Without it, decisions become limited. Investments might need to be sold. Opportunities might need to be ignored. Choices become reactive instead of strategic. With it, the dynamic changes completely. When others are forced to sell, there's the ability to buy. When opportunities appear, there's the ability to act. When uncertainty rises, there's confidence instead of fear. Building this kind of financial buffer doesn't happen overnight. It requires consistent saving, disciplined spending, and a focus on long-term stability. Automation plays a key role here. Automatically directing money into savings and investments removes the need for constant decision-making. It turns preparation into a system rather than a one-time effort. It may not feel exciting, but during a downturn, it becomes one of the most powerful financial advantages. Mistake number 10. Relying on a single source of income. Income stability is often taken for granted during strong economic periods. A steady paycheck feels reliable. Career growth feels predictable. But recessions expose how fragile that stability can be. When entire industries slow down, job security can disappear quickly. And when millions of people are searching for work at the same time, competition increases dramatically. Relying on a single source of income in that environment becomes risky. Diversifying income doesn't mean working non-stop or taking on unnecessary stress. It means building additional streams that can provide support if the primary one is disrupted. This could come from developing new skills, freelancing, remote work, or small business opportunities. The goal isn't to replace a full-time income immediately. It's to create options. Income can be treated as a skill, and like any skill, it can be improved, expanded, and adapted. During a recession, those who adapt tend to recover faster. Those who rely on a single path often face more challenges. Building income flexibility before it's needed creates a significant advantage when conditions change. Turning crisis into strength, recessions test financial habits, but they also reveal them. Every decision made during uncertain times compounds over time. Panic leads to loss. Preparation leads to stability. Discipline leads to growth. The difference between those outcomes isn't luck, it's behavior. Those who stay calm, continue investing, manage expenses, and build systems often come out stronger, not because the recession was easy, but because they were prepared for difficulty. Financial systems matter more than motivation. Automatic saving, consistent investing, and clear planning create momentum even when emotions fluctuate. Noise becomes louder during downturns. Opinions become stronger. Predictions become more extreme. Filtering that noise becomes essential. Focusing on a few trusted principles instead of reacting to every headline creates clarity. And clarity leads to better decisions. Recessions don't last forever, but the financial consequences of decisions made during them can. That's why the focus shouldn't be on predicting the next move in the economy. It should be on building a position that can handle any move. Conclusion: every recession tells the same story in different ways. Fear rises, people react, and many abandon the strategies that would have protected them. The most damaging mistakes aren't complicated, they're emotional. Panic selling, chasing fast money, ignoring preparation, relying on unstable income, and operating without a plan. Each one feels justified in the moment. Each one creates long-term consequences. But the opposite is also true. Staying invested builds resilience. Saving consistently builds security. Planning ahead builds confidence. Developing skills builds opportunity. Control doesn't come from predicting the economy. It comes from preparing for it. And those who prepare don't just survive downturns. They position themselves to grow when recovery begins. Call to action. If this breakdown brought clarity, take a moment to apply at least one of these principles immediately. Start small, but start now. And for more content that helps build smarter financial habits and long-term stability, make sure to subscribe and stay connected for the next video.